Hey everyone, welcome back to another episode of AWM Insights. Going to mix things up a little bit today. Still got Mena and Justin here, but we're just going to do a little free flow conversation. Hopefully you like it. If you do, let us know. If you don't let us know. But still have a topic of focus, and that is Q2. So we just turned the page on the midpoint of the year, looking at the back half and Q3. But it's always a good time to reflect and refocus, as our good friend Brian Kane always likes to remind us around these periods of time. So year to date, it's been an interesting year. Q2 has certainly been a positive period compared to the first quarter of the year. And so we're certainly gonna hit on some lessons learned and points to reinforce as we continue to go forward in the next 6 months. Certainly a lot to focus on. Like I said, quarter was pretty interesting. It was very much a positive quarter if you look point to point, right, Mena? But the quarter got started with a pretty monumental event, right? So-called Liberation Day. The tariffs were triggered, put in place by President Trump, and there was a pretty drastic sell-off in that April timeframe. But since then, I mean, really didn't last very long, right? Kind of short-lived. And since then, U.S. markets in particular have been on a tear, and markets overall, year to date, have been good across the board. International developed markets are in top place, followed by emerging markets, and then followed by U.S. markets. When we look at things over the year to date, I think that's roughly flipped when we're looking at Q2. So I think that the quick summary here, quick take, is that there's been a lot of volatility, but that volatility has created some opportunity, some growth. And there's a lot of lessons learned as well. We've hit on some of those, and we're gonna reinforce some of those today. So, I mean, Mena, putting it to you, as you think through Q2 in particular, like what are some of the core pillars that are reinforced in your mind?
Yeah, and we talk about diversification time and time again, but we really saw the benefit of investing in international and emerging markets. The U.S. is obviously the largest global market out there, but we saw performance, and we've seen performance year to date on the international side that is above 20%, where our markets are up 7% year to date. So that's a pretty stark difference. On the developed international side, emerging markets are also up 17%. And a lot of that is due to currency pressures. So one of the fundamental drivers is the US dollar has depreciated a little bit compared to other foreign currencies, and that's not a terrible thing all in all. But when you do look at your account, if you are invested in international companies, in emerging market companies, you will see a pretty substantial move up because those currencies are getting stronger. Those markets have also done better. So a lot of tailwinds there, and your accounts, if you are internationally diversified, have outperformed someone's accounts that's just focused on the US. So yeah, it's super important. And the way I like to think about it too is we here all live in the US, we consume in dollars, but there are a lot of things that we purchase that are produced in all parts of the world. So by diversifying, you essentially own that global economy. If you're looking to buy a Porsche, you will own a little chunk of that company. Right. And as they do better, as the euro also does potentially better compared to the dollar, you are going to have slightly more money. And if you look to buy the car, you know, you might get a little discount based on how your accounts performed. So I think that's been the biggest fundamental driver of performance, and just a little bit of, I'd say, the financial fundamentals rewarding us and how we choose to invest and look at the world.
Yeah, that's right. Going in with a prepared mind, preparation versus speculation, going in with a plan, right? These are themes we've definitely hit on. And we know that they support long-term, multi-generational, disciplined wealth creation. And we definitely want to always remember that. quick summary, though, to your point, I want to make sure everyone listening understands when our currency goes down and you're invested in markets outside of the U.S., that's actually a good thing for those investments outside of the U.S. It's basically U.S. dollar goes down, it helps increase returns for non-U.S. investments, and that's definitely the driver of what's going on, what you were just explaining. One thing I also want to hit on, there is a lot of, and we just live in this noisy world, whether it be the echo chamber of, pick your social media of choice, or just if you're looking at more mainstream media outlets, et cetera, right? There's just a lot capturing, or at least trying to capture your attention. And this idea of having a plan beforehand, another way of saying that is being disciplined versus reacting to emotions. And we certainly saw that around Liberation Day, right? The reaction was intense to the downside, and now fast forward, we've recovered, right? And we're positive for the year. And so I definitely want to talk a little bit about that. Like what are the little nuggets, let's call it, that come to mind when we think about the emotions that probably were felt by certain folks over the last 3 months or year to date even.
Yeah, and it really goes back to just sticking with your plan and making sure that your plan is not biased in one form or another. We've talked about how you should not vote with your dollars. You should vote at a voting station or with your ballot, and
they're called polling places.
Polling places, a little bit, yeah. I've only voted twice. Give me a break. But yeah, it's a little bit tough to build a plan and also emotionally factor in how you view the world politically. And then you're also relying on the fact that all of your assumptions and predictions come true, and it's just a recipe for disaster. We've seen this time and time again. People jumping out of the market, jumping into cash after the election, before the election, being happy maybe for a little bit of time after Liberation Day. But like, if you were in cash for this entire period of time, you've probably lost 20% on your money.
Totally.
Which is kind of hard to swallow, but that's how this can potentially hurt you. So staying disciplined, staying on course, and I'll actually warn against staying in cash primarily.
Totally.
Because it can erode wealth and destroy wealth during periods of time immensely. When we had inflation in 2022 and we saw 9.5% inflation over a calendar year, if you were just in cash, you weren't making anything on that money. You just lost 9.5%. The market, didn't do well, but the market recovered. And if you just stayed in cash for that entire period of time, you were hurt by inflation and you were hurt by also missing out market returns. So I'd say that's the biggest one for me. How about you?
Yeah, it's great. Well, I'd double down to an extent on what you're saying, right? You're hitting on the fear to greed cycle that we witness, right? Leading to the end of Q1, there was a lot of negativity and pessimism, and markets were starting to trail down. We had that Liberation Day contributed to that further, but it switches incredibly fast, and risk on, the greeds part of that cycle really took hold and took off to an extent. And so it's just a great reminder that reacting to news can often hurt, often does. Again, we think about things from a data perspective, and time again, the data shows you should keep that discipline in place. You should stick to your plan and not react to these short-term events, not let your emotions take over, because trying to outsmart the market really is generally speaking very much a losing proposition, a losing game. So those are core tenets to certainly how we think about markets, and the first 6 months of the year had some really, really good reminders that those are still true, that they are represented in the data. And one reminder, or one topic definitely that I also want to make sure we also bring this back to is the long-term focus, right? We're recording this podcast generally on a weekly basis. We're talking about a short-term period of time, a quarter or 6 months, but we're also very much invested for the long term in a human-centered way, right? We align portfolios with personal priorities, so and build portfolios to absolutely bolster as much as we possibly can the odds of you all reaching those priorities. Money is a ticket, not the destination in and of itself. Money is a tool. Those are the things we love to say, and I want to remind folks of that. And that's certainly how we think about building portfolios that are resilient during times like this, during tumultuous times, but they're very much long-term focused and oriented as well. So I want to use that kind of as a bow to tie everything around this conversation, and certainly the first 6 months of the year. And even leave you, as we look ahead, Mena, jump in if you have any additional comments to this, right? There is still a lot of uncertainty, even though markets were largely positive, pretty strongly positive in some cases in the second quarter. There's still a decent amount of unknowns going on around the world. I mean, today there was some data released around manufacturing. Manufacturing's been weakening for 4 or 5 months, and it's continuing to weaken both here in the US and around the world. We don't know if that's going to continue. We don't know exactly what will happen there, but it is happening. And so there's some hard data that is still not necessarily moving in the right direction. So I'd say prepare potentially for more volatility. Apply these same teachings and pillars that we've talked about today and over the last 6 months as well. And stay disciplined, right? Be prepared. Don't try to react with your emotions. So we'll wrap there. Hopefully this was helpful. A little bit of ad-libbing here, and hopefully y'all enjoyed it. So I'll conclude with the normal: own your wealth, make an impact, and always be a pro. Thanks for listening.